Hey everyone, welcome to this explainer. Today, we're going to unpack the newly outlined Income Tax Act for 2025. We're going to figure out exactly why your payouts might be shrinking before they ever even hit your bank account. You know, if you've ever looked at a payment receipt and wondered, wait, where did a chunk of my money just go? Well, you're experiencing the realities of tax deducted at source, or TDS. And here's the thing. With the new 2025 updates, the toll is getting steeper, and the penalties for ignoring it could literally land you in jail. So let's dive right in and make sense of these regulations. Look, if you earn money in India, the government wants its cut first. It really is that simple. So here's our roadmap for today. First, understanding the TDS system. 2, decoding salaried TDS. 3, taxes beyond the paycheck. 4, the golden rules of compliance. And finally, number 5, the cost of defaulting. All right, section 1, understanding the TDS system. Let's just lay down some foundational concepts so we know exactly how this tax collection functions before we hit the hard numbers. I want you to think of TDS not just as a tax, but as a mandatory toll booth. The absolute crucial takeaway here is the timing. The payer is basically acting as the official collector for the central government the exact moment money changes hands, or even the moment it's credited to your account, whichever happens earlier. You don't get the cash first and pay the tax later. No, the toll is taken right at the source. Moving right along to Section 2, decoding salaried TDS. Let's look at the Section 392 rules and how this applies to the most common way people earn a living, a standard salary. For the vast majority of the workforce, Section 392 is the big one. Under this section, your employer is required to deduct an average rate of income tax based on what they estimate your total yearly income is going to be. But here's the really empowering part for you as an employee. You actually have some control here. If you have income from previous employers in that same year, specific tax reliefs, or even losses from house property, you can proactively report those particulars to your employer to adjust the deduction. Interestingly enough, employers also have the option to just pay the tax on non-monetary perks themselves rather than clipping it from your cash salary. Okay, jumping into Section 3, taxes beyond the paycheck. Under this Section 3093 rules, things change drastically once we step outside that traditional 9-to-5 job. This is the million-dollar question in today's gig economy, right? What if you aren't on a salary? What if you're a freelancer, a landlord, an independent contractor, or maybe a crypto investor? Well, you're no longer under Section 392. Instead, Section 393 takes over the driver's seat, and it outlines a completely different set of specific rates and thresholds depending entirely on how you make your money. Let's trace the journey of the rupee for the modern economy. If you're earning professional fees exceeding $50,000, there's a standard 10% toll. If you're a contractor, it's 1% for individuals or 2% for others on payments over $30,000 for a single contract. Renting out land or a building for over $50,000 a month, bam, that's a 10% deduction. Even the modern frontier of virtual digital assets like cryptocurrencies is captured here with a flat 1% cut right off the top. And get this, there is absolutely no minimum threshold for crypto. Every single transaction gets clipped. Now contrast those standard 1, 2, or 10% rates with the sudden, sobering reality of this next number, 30%. Yeah, 30. If you win the lottery, dominate in card games, or even solve a puzzle for cash exceeding 10,000 rupees, the government takes a massive 30% instant cut. Literally, even your Sudoku winnings aren't safe. It's a really stark reminder that windfall gains are taxed heavily, and they're taxed immediately at the source. Or consider this massive threshold in the real estate world. If you're buying a movable property and the value crosses that 50 lakh rupees mark, the burden actually falls entirely on you, the buyer. You are legally required to deduct 1% on the higher of the consideration amount or the stamp duty value before you even pay the seller. You basically become the toll collector for the government. So, with all these different rates and rules, the complexity can feel a bit overwhelming. Which brings us nicely to Section 4, the golden rules of compliance. Let's run through the key requirements. The absolute most critical rule of the whole shebang, it is mandatory for the payee to provide a valid permanent account number, or PAN, to the deductor. Why? Because failing to do so spikes your standard 1% or 10% deduction up to a punishing 20% default rate. Imagine expecting to lose 1% of a payment and instead losing a fifth of it simply because of missing paperwork. Just absolutely brutal. But hey, what if your total income for the year is actually going to be below the taxable limit? You can legally reduce or completely eliminate this toll. Step 1, if your estimated total income is nil, resident individuals can submit a written declaration. You might know these as Forms 15G or 15H for things like interest, dividends, or rent. Step 2, if you don't qualify for the total exemption but your income justifies a lower rate, you can apply directly to the assessing officer for a lower deduction certificate. The system definitely has built-in relief, but you have to actively step up and claim it. All right, up until now, we've focused heavily on the payee, the person receiving the money. Now, we need to shift our tone for the business owners out there. Section 5, the cost of defaulting, which is governed by Section 398. If you are a business owner or a payer making these deductions, listen closely because the consequences for failing your duties are extremely severe. If you miss the mandated timelines for deducting the tax, or worse, if you deduct it but fail to actually pay it over to the government, you lose your good standing. You are officially branded by the government as an assessee in default. And let me tell you, that label acts as a trigger for an absolute cascade of financial and legal headaches. First comes the interest, and it compounds so rapidly against you. From the exact day you were supposed to deduct the tax, a 1% per month interest rate begins ticking. But once you finally deduct the tax from the payee and you still haven't transferred it to the government, that interest rate jumps to 1.5% per month. The government penalizes you much, much more harshly for holding on to money you've already taken from someone else. And honestly, it gets worse. The government has the authority to slam you with a flat penalty equal to exactly 100% of the tax you failed to handle. Forgot to deduct 1 lakh rupees? You could be forced to pay that 1 lakh rupees straight out of your own pocket as a penalty, on top of the interest. It's an incredibly steep price for a simple administrative oversight. This quote right here is the ultimate warning to any business owner, written directly into the act. If your failure to pay the deducted tax is deemed willful, this isn't just a financial slap on the wrist. It is a criminal offense that can lead to rigorous prison time, ranging from 3 months all the way up to 7 years, plus a fine. The government treats TDS as its own money, and withholding it is treated with the utmost severity. So we've covered a lot of ground today, right? From the basic rules of salary deductions, to the granular percentages on contractors in crypto, all the way to the severe legal penalties of noncompliance. With these strict new thresholds and massive penalties outlined for 2025, you really have to ask yourself, when the tax authorities inevitably audit your next payment cycle, will they find a compliant business or an assessee in default facing a 100% penalty and potential prison time? Don't wait to find out. Audit your systems today. Thanks so much for joining me for this explainer, and I'll catch you in the next one.